Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for July 5th of 2026. Get started with the chart pack this week. We'll kind of provide an update here on the current estimates for recession risk, current probabilities. Continue to slide a little bit from where we were towards the end of last year. You can see here, the consensus estimates were falling in line around 30% towards the end of last year and the beginning of this year. And right now we've got Goldman Sachs around 15% based on the preponderance of economic data that is out there. And the fact that we have a Fed policy which seems to maybe be on a bit of a temporary pause here, with the bias obviously towards raising rates as opposed to lowering rates, but current Bloomberg consensus huddling around 25%. Again, not real strong numbers here, not a lot of consensus feeling that we're close to a recession. Obviously there are some data points when you talk about, consumer sentiment and leading indicators and some other data points which, typically, levels that they're currently exhibiting might foreshadow recession risk, but there's enough positive data points out there that help to offset that, at least for the moment. Here we have gas prices and WTI crude. WTI here in the orange number, this from our friends at First Trust. You can see the escalation of hostilities here in the first ceasefire, and since then we've seen really kind of a leveling off and then eventually an abatement of sorts in overall crude prices, and of course gasoline follows, being a distillate of crude, and you can see that the gasoline prices are falling off at an appropriate time too, as we really kind of like tread very heavily into the summer driving season now, and you can see this clearly in decline along with crude prices at the moment. Trade policy is also on the way down. You can see obviously the peak a little bit earlier, and that is now come down quite a bit. Again, well above prior levels, and typically you see just like a spattering of trade policy issues in the absence of like a major tariff agreement, which you can see back here. We had a little bit of that leading up into the pandemic, but again, these levels were astronomically high. A lot of uncertainty at this point, creating some volatility in the market, and a clear trend downwards there in terms of its uncertainty. Ships passing through the Strait of Hormuz, you can see, again, it's not all peaches and roses yet, but it is getting better. You can see that on a weekly basis, we continue to trend incrementally higher, and we're represented by really most of these vessel types. It's not just one that's getting through. Now, again, we've got a long way to go to get back to the pre-conflict levels, but it is a start, and that's having an impact on the crude prices that we just looked at, as well as perhaps some economic expectations. We have global internet traffic. This is a pretty interesting chart because we've had such a geometric rise in internet traffic volume. Again, the proliferation of AI has certainly expanded that and kind of helped this geometric expansion. But at the same time, what's really important to take into consideration by virtue of BCA's research here is we can see that capital spending as a percent of GDP from the Bureau of Economic Analysis, that's in this darker line here, that continues to slide. And then broadband providers, that continues to slide as well. So we're getting more bang for the amount of dollars that we're investing in the infrastructure. So we talk a lot about tech and AI and market leadership, and and we have had some very narrow leadership in the equity markets, but usually markets are driven by profits. That's the E in the price to earnings ratio. And there's a reason why, multiples really haven't expanded that much. It's because earnings have greatly expanded. And so you can see here the Magnificent Seven profit margins continue to expand with a bit of a hiccup here, but you can see, for the rest of the 493 stocks in the Bloomberg 500 index here, again, this is a very close proxy to the S&P 500, but you can see profit margins for the rest of the index have pretty much flatlined. And then kind of along with that, you can see why some of these profit margins continue to expand is that we actually have prices for computer software and accessories. And this is a very rare sign. You typically see technology in a kind of a decelerating price environment as you get, just think about the first, cell phone that you bought and what that cell phone would cost you today. And typically you have very strong and pronounced price deflation as you have more technological advancement. But here lately, we've seen something kind of akin to a perfect storm. So AI, I think, this is the wild card heading into 2027. Notwithstanding the second half of this year is, the earnings projection. Obviously there's been a lot of estimates for capital spending, which we kind of talked about a little bit briefly, but the hyperscalers are, expected to spend maybe upwards of $1 trillion on capital spending. Well, what are the earnings that they're going to get from that, and when does that come? And so, this is the current market expectation right here, and this is the trajectory. If you're gaming it to where those benefits come along later, and so the big issue right now is the debate over when do you get those returns on investment, because a lot of people are actually having to maintain the current spending that they had before AI implementation, but they're also having to spend to implement the AI. So ironically, you wind up having higher costs as a result of AI in the short run, and you have to wait longer to get that return on investment. And this is what this is trying to depict here, is that you wind up having a longer runway to get to the same level of returns. So this is something from the Financial Times I thought was very interesting. So, this is, basically as we all look at the AI sector, the AI theme, and like, okay, where are the landmines here? And, we look at the tech sector, earnings growth year over year. We just talked about that. Earnings are going up, but the sectors that are expected to use AI heavily are actually trending a little bit lower. That's not to say that they're negative or the opportunity is going away. That's not the case at all. It's just that it's not playing out in parallel. And what's really interesting is that there is a positive relationship here. I'd say the correlation is not super high, but it's high enough that you respect it. And having this go that way and that go that way is a bit odd. And so again, it's one of these things that we watch that we say, all right, well, something's got to give here. Either this is going to, level off at some point, or you're going to have, more, adoption. And I do think that will play out, but it is interesting to see where we are right now amidst the euphoria and the enthusiasm over this whole theme. So here we have the pension funding index. This is something that certainly in my prior life, when I did a lot of investing for endowments and foundations, I spent a lot of time thinking about. And we spent a long time with deficiencies in our pensions. That we were underfunded in our pensions, and it's led to in some cases it's led to poor investment decisions as you're trying to catch up. In other cases, it's led to actually defaults, and in most adverse cases where you have to be bailed out by the Pension Benefit Guaranty Corporation. But that is not the case right now. That on balance, that the funding ratio is above 1. So we are in positive territory. So pensions that support defined benefit type plans are actually well funded at the moment, and some of that is a lot of that actually is a byproduct of a continued good stock market. Here we have the Atlanta Fed. We update you on this periodically. We've had further deterioration in their estimate for second quarter growth. You can see here, this is where first quarter ended up, about 1.5. Actually, we had a final revision that was up closer to 2%. But in any case, the estimate for second quarter is looking fairly bleak. And we'll get this number in about 2 weeks, maybe 2.5 weeks. So we'll obviously be on guard for this, and this would be a very interesting development coming on the heels of first quarter. And so, again, looking at slower economic growth, but not negative. And then we're looking at the prospect of a rate hike. And you can see, that basically this would be like no change in rates. And for the longest time, we're expecting, 2, and in some cases back in late third quarter last year, looking for 3 rate cuts. And that's just obviously gone off the table now because we've got inflation that was born out of the energy complex and some other areas that seems to be somewhat persistent. I do think once the Iran conflict finally sees some kind of like light at the end of the tunnel, that we'll see some of those inflationary pressures ease off, as we already have in the crude market. But nevertheless, the estimate is still for a hike. The bias is still for having a rate hike before we have any more rate cuts. So central banks across the world are now at a point of inflection. And so, basically, we've got, hikes versus cuts, more dovish right here. And they're still dovish across the globe. But once they pass that zero line, and you can see that these things are inherently cyclical, then they will be, the central banks around the world will have a bias towards tightening credit or being more hawkish, as opposed to loosening credit or being more dovish. And so this is an equally weighted policy rate. These are hikes versus cuts, and this is actually the policy rate. Now we begin to see that inflection point turning up. So we have the beginnings of what could be kind of a global modest tightening cycle in the face of some of the patent inflation that we've seen. Here we have the Institute for Supply Management Purchasing Managers Index, the ISM PMI for June. It was a little bit below expectations, nothing to worry about, however, still solidly above 50. Again, the manufacturing PMI has been sluggish for quite a while now, been negative, in fact, which anything below 50 represents contraction, but it is solidly still above 50. I think in pretty good shape there. So this is one of those areas that helps to drive that probability of recession lower. New orders we can see here, again, positive above 50 after a prolonged period of sub 50. So good numbers there on balance. Now we have that same ISM new orders number here in the black line. This is versus inventory. So again, we see those areas as well. So bodes well for inventory accumulation. We've got the ISM manufacturing PMI that's lagged by 2 months, and you can see that both of those are tracking above 50. Got construction spending. I'd say this is fairly tepid. So it was a little bit below expectation. You can see that we had some negative prints here for some of the prior months. And then we had a bit of a reversal, but that's lost a considerable amount of steam. Now, again, not all construction spending is made equal. Obviously, there's different areas that are winning, other areas that are not. So we've got residential in the black. That's pretty much flatlined, and kind of supporting this deceleration here. And then we have non-residential that's clearly finding its way lower. Now, where we're seeing a lot of this decline is in the office sector, and that's no surprise. We still have a lot of inventory, sublease inventory that needs to be absorbed because of the vacancies that were born out of the pandemic. You can see here that this has just been kind of a sliding scale ever since the pandemic. But you see the positive numbers here are actually generated because of this, this parabolic move in data center construction. And I see that the rate of change was really strong here, maybe the rate of change is just leveling off enough. But again, with all of the capital spending that's planned by the hyperscalers, this number is going to continue to move higher for quite some time. Here we have a quick check-in on the labor market. Again, this is employed, full-time employment, and this is where we kind of take a look in the mirror a little bit and say, and do some self-reflection on where we are. Labor is not in a bad spot. I've said multiple times that we've have this environment where we're kind of in no hire, no fire. But it's just looking really sluggish, and this is data from the St. Louis Fed, excuse me. And then here we've got new hires on a net basis. This is information from Gusto, but this is small business hiring. And you can see that that's just been really flat, really sluggish for a while. So labor market not doing poorly, it's just not doing great. Again, remember, this is one of those two mandates of the Fed, along with stable prices, that you have stable employment. Apartment list mean prices, you can continue to see that that's trending lower. Vacancy levels still remain high. Actually, they're higher than at their peak point just after the pandemic. So expect rents to come down lower. This, when you look at it through a different lens, it is actually a benefit to have lower rent prices, even though they're well above where they were, right? Let's not fool ourselves. Rental prices are still a lot more expensive than they were, but they're just coming down. And this has a disinflationary benefit to overall inflation because of the calculation of the consumer price index and the impact of rents and wages on that. Here we have gold futures. Gold is in a bit of a reversal. I think technically this is a very interesting point now. So we've got the shorter term 50-day moving average that just slammed into the longer term 200-day moving average with that gold price turning around. Now they, technicals call this the death cross. And so when you have that, you tend to see sluggish technical performance out of these data series for some time afterwards. And so if that were to be true, then you're going to have gold prices that are going to be sluggish for a little while. But as we've said multiple times, we have, the demand for gold has certainly been well supported in a lot of different areas, not the least of which of central banks that are divesting of treasuries and investing more in gold. So not sure how far this is going to fall, but this technical indicator would suggest that it's going to be sluggish for a little bit yet. Now, sliding over here, we've got Bitcoin. Again, speaking to all of you speculators out there that felt really proud of themselves up here, and unless you had the gumption to sell and you had the mindset of a short-term trader, more than likely you rode this all the way down. And so this is just to highlight all the things that we've said. I've not minded one bit having somebody that has Bitcoin in their portfolio, but just understand what the ramifications are, because basically Bitcoin from, we'll call it towards the end of last year, is basically down 50%. Okay, so we talked about gold just now, and we talked about silver too. And so one of the things that, we'll call it back in 2025 in the second half is like, oh, we're going to see a problem with gold, with the US dollar. And that's going to lead to higher gold and silver prices. Well, the speculation of that actually did send gold and silver higher, but the reality of it is that dollar has actually strengthened just slightly here over, call it the last 5 to 6 months, at the same time that we've seen an erosion of gold and silver. So this is, it kind of highlights the risk of these short-term kind of like momentum trades where, you place some pretty heavy bets on gold moving higher and the dollar moving lower, when in fact, when a lot of signals, even in real time, would probably suggest that maybe you'd have a weak dollar, but that in fact was not the case. So it's just more power, I think, to the argument of longer term investing and not being so caught up and beholden to these short term velocities, if you will. Continuing on with the gold theme, as I mentioned, central banks buying a lot of gold. You can see that here. These are gross purchases that are offset by some sales here, but the net change has been decidedly positive for quite some time. As we jump into the equity markets here, I have a chart that does a really good job of kind of hitting on some of the main themes that we've seen over, call it the last 100 years or so. And what we have here, starting with this data series back in 1920, again, long-term bias up. There are years that we have struggled. That we spend basically 70% of the time, 70 to 75% of the time in up markets. And again, this speaks to the power of long-term investing, but we can see why this is, why we have these prolonged cycles here. Now, this would be modern electronics, automation, computers, just on their very advent, like we call it around World War II, all the way up through kind of the beginnings and, really the crux of the Cold War here. And then you have some years of sluggishness, and then you get into the PC boom and also the internet back here. And then we had, what a lot of people kind of term as kind of that lost decade after the tech bubble bursting. And then beyond that, you had smartphones and the e-commerce boom. So, which actually started back here, but really gained steam here over this prolonged bull market that we saw that was just it was only stunted by the pandemic. We have the forward PE ratio. As I've mentioned, we've had strong earnings driven by the tech sector and in particular by semiconductors and the Mag 7 to some degree. You can see that stronger earnings have actually brought that multiple down. So it's not as egregious as it was. You can see the 5-year average is about 20 times. So we're not too far off that. If you go back 10 years, the average is about 19. So again, we've kind of like, shed the froth here of some of these rich valuations. But that's not to say that things are cheap, but at least they're not as expensive as they were. Here we have a couple charts that I thought were really telling. This just gives you a sense of, all of the liquidity that's come into the market and where we stand as a global market for stocks. And now we've reached essentially 166 trillion. You can see geometric rise. If you go back literally 15 years, that's a fourfold increase in the size of the market. Now, that wasn't without its bumps and bruises, mind you, but again, the power of long-term investing is very potent here in this analysis. You got a lot more individual investors in the market. You have a lot more liquidity that is being mobilized to put into risk capital, and that's why you've seen such a dramatic rise in a relatively short period of time in the overall size of the market. Now, the other thing on this side, which I do find a bit concerning, is the rise of margin debt. And again, with higher interest rates, that margin debt is more expensive. But in a lot of cases, as you can see here, this geometric rise in margin debt, that there's frankly a lot of people that don't care, that they feel like you've got the cycle that's going to extend. Maybe you have some continued upside without volatility. But then again, maybe you don't. Maybe you've got more volatility on the near-term horizon. But this has historically been one of those signals that you got to pay attention to. And you look here, the pandemic, and then post-pandemic market rally, and you got a lot of euphoria. But there have been times where you've had a lot of euphoria in the market, and people thinking, well, this time is different. Market's going to continue to move higher. I'm going to leverage that, and then they get caught with their pants down. So, again, one more reason right here to be eyes wide open to potential market volatility. We've been talking about earnings growth. You can see that here. What's very interesting here is that we have the percentage of stocks within the S&P 1500 with positive earnings growth year over year is actually moving higher. And that's a good sign here. It's basically this number's over. This is on the left-hand axis, so we're talking about like 75% of all of those 1,500 companies. So that's a positive sign. And then you can see the relationship here with what we looked at a little bit earlier was the Institute for Supply Management Manufacturing Index moving higher. So there is a positive relationship here. And with that ISM moving solidly above 50 and hopefully staying there, then that does give a lot of staying power to earnings across the broad spectrum of the stock market. And then here we have net guidance. And obviously the enthusiasm over earnings here in the second quarter remains very high. Now we talk about relative valuations, not too surprising. We've got technology that's done wonders, really in a pretty dramatic fashion here, but at the same time we've got defensive stocks that are kind of losing steam. And so, you do see that these things tend to work in opposites here. So that is not surprising. Question is, where do we go now? A lot of people are concerned about techs being overextended price-wise, and that may be the case, but earnings are still moving higher. We'll see here in a second that we've got, the Micron case study is really an apt one for this environment. But again, you have appetites for a certain stock when you feel like momentum is on your side. You're not going to put as much value and emphasis in some of these defensive names, and they're naturally it's a supply and demand issue, and prices tend to go down to find that equilibrium point. And you can see the relative value there has actually improved for defensives. We're just not in necessarily a defensive mindset, at least right now. But if volatility picks up, that could certainly change. Now we have the Micron case study, and I think this is really interesting because Micron for many years was, almost an afterthought in technology. They made DRAM chips, which is, basically commoditized memory chips, and go into a lot of things. It's an Idaho-based company, had problems getting into China. There's a lot of backstory to this, and pretty solid company with good cash flow. It just wasn't a darling until it was. And you can see here, this is a case where, Apple, in its quarterly net income continues to move higher. And you can see that the demand for memory has absolutely exploded with the AI invasion, as I'll call it. And so you actually have, on an aggregate basis, you have profits from Micron that are almost that of Apple, and you can see price changes for DRAM memory, which is what Micron makes, continue to move higher. And this is in both of these, like NAND storage and DRAM, both tracking a lot higher than they were. This is helping to contribute to that inflationary environment, that very odd inflationary environment that we see in tech right now. Mag 7, we see because of the earnings growth that some of those companies are generating, we actually see that the premium of their price to earnings ratio, the premium of their valuation relative to the rest of the S&P 500 has actually gone down and has continued to go down after really exploding in 2023. Hyperscaler free cash flow. This is something I've shared with you at least once or twice here over the last month. And, again, everyone loves the story of capital spending, but I'd say really over the last month, maybe the last 2 months, there have been moments of skepticism. It's like, well, okay, your free cash flow is declining. How are you going to support the spending program that you have? And obviously, mathematically, a free cash flow would be determined by operating cash flow minus capital spending requirements. Now, a lot of the spending on data centers and whatnot, these are discretionary dollars, not necessarily required dollars to maintain your current infrastructure. So, so there is some financial gymnastics at work here. But be that as it may, we've got declining free cash at a time where there's high expectations for build out. Again, these companies are going to have to prove out, right? There's skeptics out there that look at this and say there's no way that they're going to be able to support the spending that they're announcing. So again, potential volatility on the horizon from the skeptics. Software. Talked a lot about software, and we've talked about software in a lot of different realms too. Like we talk about private credit and business development companies, BDCs, a lot of them really having valuation re-ratings. I mean, being their valuations cut in half because the risk that is perceived that AI is going to supplant software and render a lot of software platforms moot. And so as a result, price to earnings ratios, the multiples afforded to software companies relative to the S&P 500 continues to move lower. Now, this is the IGF iShares for software. You can see that forward PE continue to move lower at a time where the S&P 500 is kind of like tracking, as we saw like a couple slides ago, is really kind of like tracking in line and maybe going down a little bit as well. Small cap interest burdens, I'm just basically reading this headline, continue to rise. So, we just talked about earnings moving higher for the S&P 1500, which encompasses both the S&P 500, the S&P 400 mid cap, and the S&P 600 small cap. But as we look at small caps in particular, with rising interest rates overall, the interesting thing here is that we've got interest expense as a percent of EBITDA is moving higher, whereas for the rest of the S&P 500, it is actually going down. So more stress at the smaller company environment, even though there's overall greater earnings, but something to pay attention to, particularly because like when we look at 2022 was 18.2 and 2026 is now 31. So a jump of that magnitude is something that we should be certainly paying attention to with regard to small cap stocks. Now we'll switch and talk about private capital, private equity. We've got venture cap deal activity by quarter. We've seen a concentration in very large deals. You see deal counts have actually continued to go down, and this is from PitchBook, but deal values have actually gone up. So we see more mega deals, and you see exit activity. Obviously, this is certainly talking or inclusive of SpaceX. So let's not get too carried away. Again, exit count, the number of companies that are exiting is, well, I'd say right now, going back to 2024, let's call it flat for simplicity's sake. But you're getting more of these mega deals, and that's causing a kind of a parabolic rise in the exit volume from a dollar standpoint. Here we have AI funding, again, from a private side, perspective of private investing. AI funding is continuing to move higher. Again, same theme here. You've got deal counts that are lower, so more large deals are getting funded. And something else that we haven't talked about in quite a while is the special purpose acquisition companies, or what they call SPACs. Their IPO numbers are actually picking up, and this is something that's been playing out actually for, let's call it about a year and a half, and it was doing so rather silently because that was all the rave back in 2020. This is an environment where companies are merging into shell corps to go public, so they're kind of like going the reverse route of going public, and they're merging into a public vehicle, and a lot of companies did that after the pandemic. that were honestly not ready to be public companies. They were losing a lot of money, so on and so forth. And then basically for a couple of years there, that whole area, the SPAC area, just dried up completely as a lot of these companies wound up going bust. But that market has picked up again, so something else to watch. Now we'll talk about the Treasury market, talk about bonds. You can see, if we go back to March, this is your Treasury yield curve. And if we look at it basically at the end of last month, which is essentially last week, you can see where on a shorter term basis, interest rates have gone up. And this is what this depicts. So you go out farther on the curve, and we haven't honestly had much of a change in long-term rates. So let's just call it long-term rates are still very anchored. Long-term inflation expectations are still very anchored. It's what we're looking at here over the shorter term period. And if you're sitting here in 2026 and you look at the 10-year Treasury, that has certainly moved higher. And if anything, you've seen a little bit of flattening in the curve, but it's still very positively sloped. And as you can see, the 2-year yield, we've been talking about for a number of months now, that you've got interest rates that have continued to move higher. And like I said, you've got 2-year yields about 4.1, and then you got 10-year yields that are actually not that far above that. So at least from a 2 to 10s perspective, you've seen some flattening. So this chart from Alpine Macro, it gives you yet more perspective. So let's just call this, like the Treasury inflation protected securities yield, or TIPS yield. That's in the red here. So the TIPS yield has gone up. And if you look at where that yield is relative to the inflation numbers, you can see that the break-even inflation rate has dropped. And this usually is a setup for a very good market for TIPS. So basically you've seen higher yields, lower prices, and it usually sets up to be a pretty good buying point, and that's why you've got this environment here that is, at least by Alpine's definition, they're calling it the Goldilocks period, where you can buy TIPS cheap. Basically, you get inflation protection on the cheap. That's all we have for today. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.